Welcome back. You're with us on Closing Bell. Well, let's now go across to Shereen, who is in conversation with Anish Shah, Group CEO and MD at the Mahindra Group, to talk about expectations from the budget and, of course, the economic survey that has just been tabled. Shereen, over to you.
Well, thanks very much. Yes, we now do have the fine print of the economic survey, which is a precursor to the budget announcements that will follow tomorrow. But let's go across to Anish Shah. Anish, many thanks for joining us here on CNBC-TV18. Let's start with what the survey highlights in terms of the growth projections. Sanguine on growth, also sanguine on inflation, saying that growth is steady and inflation is under control. 6.5 to 7% is what the survey assumes as far as growth forecast is concerned, which is on the lower end, on the more conservative side. How do you read this, Anish?
Shereen, good afternoon. We do see this as conservative as well, but from a budget standpoint, it's good to be conservative. We feel that it will likely come out higher than that. And we see a number of other positives in this survey. Inflation being under control is a significant positive. And then as we look at some of the real numbers that have been shown for F24, capital formation is 9% higher, and that's something that is fairly significant. We see unemployment down from 17.8% to 10% at the youth level. And as we look at our demography and our job situation, that is also a very positive indicator. So I see a number of positives coming out in this survey.
Well, speaking of positives, but also trying to extrapolate what we could perhaps see in the budget, I want to talk about what the survey highlights in terms of India's vision of becoming Atmanirbhar. Over 1.28 lakh crore rupees of investments being reported until May 2024, which has led to production or sales of 10.8 lakh crore and employment generation, both direct and indirect, of over 8.5 lakh under the PLI scheme. The ask from industry is that there be more PLI schemes that are rolled out, at least as far as labor-intensive sectors are concerned, Anish. Is that the expectation that you go into the budget with? If yes, any specific sectors that you believe deserve to come under the PLI net?
Shereen, jobs is clearly going to be a big focus on the budget. And our view from an industry standpoint is that capital formation, investment is the way to go to create a long-term economy and not something that's done for the short term. We like PLI schemes that have come out so far. And the key factor always is that the incentives that are given should have a meaningful and lasting impact. So in that context, we would probably expect fewer PLI schemes than we've seen before. But what we would ideally like is a greater investment in infrastructure, a greater investment in capex formation that will be positive for the economy in the long term.
Yes, there is a whole chapter on infrastructure, Anish, as you pointed out. But, you know, the indication is that perhaps the government has done a lot of the heavy lifting, especially in the last few years, with record numbers being allocated there as far as public capex is concerned. And now the ask is of the private sector to do its bit. In fact, the survey talks about targeting 35% of private investment to GDP. You know, what do you go into the budget with? Do you expect that it will perhaps do a little bit better than the interim budget in terms of public capex?
We feel that it will. And you're also right that private capex has to step up. It hasn't so far. FICCI's manufacturing survey shows higher capacity utilization across industries and also shows that 47 to 48% of companies are looking at investing over the next 12 to 24 months. And that is something that will help private capex grow significantly.
Anish, you know, you talked about jobs, and the survey highlights that we have seen an improvement as far as the unemployment number is concerned. The survey also talks about the fact that India needs to generate an average of nearly 78.5 lakh jobs annually till 2030 in the non-farm sector. I mean, this is a pretty daunting task, daunting ask to Anish of the private sector, which will need to in many ways do the heavy lifting when it comes to job creation, will it not? Is this doable? Is it feasible?
Daunting but possible, Shereen, because as we look at the Viksit Bharat goals, manufacturing has to grow multifold. Today, India has 3% of global manufacturing. Our target is to get to 12%. If we look at manufacturing as a share of GDP today, it's 16%. And we will need to get to somewhere between 20 and 25%, likely on the higher end. If we get to 25%, it means manufacturing has to grow 16 times in the next 23 years. And for that, India has to be the manufacturing hub of the world. A number of actions are being taken to make that happen, and which is again why we harp on government focusing on long-term aspects for the economy, putting in the capital that's required to add to what the private sector does as well. And that partnership, I think, will help us get to those manufacturing numbers and to those jobs that come with it.
You know, you talked about the manufacturing aspiration, Anish, and the survey throws up an interesting idea or an interesting thought. It's asking for a review, essentially, of the policy with regards to China and saying that in light of this China +1 diversification, India should allow FDI from China to come in so that we actually integrate into the supply chain and ensure that what we're now seeing, you know, with business going to Malaysia and Vietnam and Indonesia, that isn't the case. So the survey calling for perhaps a more pragmatic view of the policy with respect to China. I want to understand how you as industry see that.
So the China policy has been driven by geopolitics. And that's an area that we will leave to the experts to think about. The one area that we will highlight is that across many industries, we are seeing cheaper imports coming in from countries that have high capacities. And we've seen the US and Europe starting to raise tariffs in certain areas as well. So that's one thing that will impact our focus on India being the manufacturing hub of the world, and something that the government will have to look at in terms of how it moderates it.
So, Anish, you know, the final countdown has begun now for the 7th consecutive budget that the finance minister will present. You know, again, there's a long wish list of asks that's come in from industry. But if I were to ask you to whittle it down to one or two things that you believe will ensure that this is a budget that is appreciated, it's a budget that will continue to amplify and build on the growth momentum, what would those one or two things be?
So more on long-term economic growth and investment in capital expenditure. Second is less of populist schemes because we need more towards the long term. And third is a focus on jobs and manufacturing.
On that issue of, you know, this business of that the budget could deviate from the recent past and be more populist, is that an expectation that you have? And on the back of what you've seen, for instance, in the survey, and not to suggest that the survey it's only an indicator of what the budget may or may not do, but do you get that feeling that this is likely to be a departure from the recent past with more populism, so to speak?
Actually, the political realities do point towards some element of populism, at least. We were very pleasantly surprised last year when the government did not go down the populist path in an election year and focused on a budget that was long-term and that was good for the country, and a lot of credit to the government for that. But again, there are political realities that have to be balanced.
So finally, from an auto sector's perspective as well, Anish, and you know, the question mark on the FAME subsidies and what shape or form FAME 3 can take. But outside of that also, you know, confidence building measures, so to speak. You know, what would the expectation be, the two or three things that you would watch out for in the fine print?
We would essentially want to stay the course in terms of where we are right now. I feel that we have got a good set of subsidies. Yes, FAME 3 is essential as a replacement of FAME 2 because FAME 2 has done a lot in terms of having the impetus for change to electric, especially in electric three-wheelers. And that impetus needs to continue for another 3 years for FAME 3 and then stop there. We don't need it beyond that. But that is important for it to continue. So therefore, I would just say stay the course. The rest of the incentives are in place. It's up for industry to now deliver.
Stay the course. That's the message coming in there from Anish Shah, the Group CEO and MD of the Mahindra Group. And I think that's the message that the economic survey is throwing up as well. The steady as she goes, that's chapter 1 of the survey. And that clearly seems to be the indication that the chief economic advisor is handing out by way of his second economic survey. Anish, always a pleasure. Many thanks for joining us today, and look forward to seeing you tomorrow bright and early as we get ready to listen to what the finance minister finally delivers in her budget speech. Guys, that's the economic survey. That's the industry reaction. Back to you for now.
All right, Shereen, thanks very much for that. And of course, all eyes on what actually does come out. But interesting conversation there with Anish.